What's up, everyone? It's Karthik with MoneyVest. So markets here hitting a new all-time high. The S&P 500 closing well over 5,700 for the first time ever, pushing up over 1.7%. We've got the NASDAQ. So this was a very tech-driven rally. It was a very risk-on environment in the markets. Everybody was cheering this Federal Reserve rate cut of 50 basis points, and the NASDAQ up 2.5%. The Dow Jones pushing up over 42,000 points on the day. My personal portfolio was up a little bit over $20,000. So very strong day in the markets from a long perspective. But I really want to give you a very objective and real analysis about the economy and where we are in this current cycle of rate cuts, because the Federal Reserve did embark on a very big rate cut yesterday, as we discussed during our live stream and the market update as well. But really the question is, what's going to be the consequences of those rate cuts moving forward? Because there's a lot of similarities to what we are seeing now versus what we have already seen in the past. It's actually quite crazy how even the dates and the headlines and the reactions are similar to what we witnessed back in 2007. So for example, by the way, this right here is the entire greenery that you're seeing. Nvidia up over 4%, Apple pushing up 3.7%, Meta hitting a new all-time high, Tesla up over 7% on the day, Broadcom, AMD, so all semis, all risk-on assets pushing higher on the day here. Technology leading this market up over 3%. Now, before we get any further, I really wanted to go over this particular chart, which essentially shows you the historical Federal Reserve rate cut cycles and how many times after a rate cut we have entered into a recession. And that number is a whopping 10 out of 14 times. So if you look at these entire metrics, the only 4 times that we did not get into a recession was 1998, 1995, 1984, and 1966. Every other time we have gone into a recession after the Federal Reserve has cut interest rates. And the current cycle, of course, is putting us right about here with a significantly lower savings rate from the U.S. consumer as well. So we're saving pretty much under 3% or $3, in other words, for every $100 in earnings for the consumers. And the unemployment year-over-year growth, this is actually tracking the change on a year-over-year basis for unemployed persons that we're seeing in the US, and we've gone from 6.3 million to now sitting well over 7.1 million people that are unemployed. So, in the last 1 year, we've essentially seen almost 1 million people more unemployed in the US. Basically, the unemployment growth increasing by 12.2%. Now, this right here was the article back in 2007. So interest rates slashed to help the economy. And again, if you read some of the words here, they're very similar. The Federal Reserve cut the target on the key short-term interest rate by half a percentage point, and the stocks surging following the announcement, with the Dow finishing the day up more than 330 points or 2.5%. The NASDAQ shot up 2.7%, while the S&P 500 closed nearly 3% higher. And furthermore, stocks surge on a rate cut. The Dow Jones Industrial Average jumping over 335 points or 2.5%. The NASDAQ, the S&P 500, and this right here from Stuart Hoffman, the market's reaction is pretty clearly hallelujah, right? Hallelujah. So this was literally from September 18th, 2007. So just exactly, 14 years ago? Or no, 2007, so 13 plus 3, 16 years ago. So 16 years ago, we witnessed this exact rate cut and this article play out 17 years ago. And we know what happened, right? Markets continued to rally all the way through October of 2007, and of course eventually had a much bigger sell-off. Now, Reventure actually did a very good job in putting together some indicators that they're tracking on a regular basis to better understand where we are in this current cycle. I took it a step further. I added a few more indicators that I think were very important. I've done a very similar analysis, but a little bit more on a paragraph style. But this right here is going to be the current state of the economy based on some of these very important data points. So first things first, the CPI, which is the consumer price index, that's the inflation number at 2.5%. So that's pretty much a normal reading at the moment. Now, the reason why everyone is so optimistic that, look, we're not going to get into a recession, everything is fine, is because of what we're seeing from the economic standpoint and also from consumption expenditures standpoint. So economic growth still continues to be very strong at 3.1%, with consumption expenditures on a real basis sitting at 2.8%. So those are the two indicators that continue to be very strong, suggesting for no recession in the U.S. or potentially no recession in the U.S. Now, there's retail sales that are weakening, down about 0.5%, and that is relatively weak. We got unemployment growth, as I pointed out earlier, 12.2%, as unemployed persons is increasing now on a year-over-year basis. That's weak, and that's probably why the Federal Reserve decided to cut interest rates in the first place, and such a bigger rate cut than as opposed to 25. And then unemployment rate, however, is still low, right? So it's still in a normal rate here, 4.2%. That's also one of the reasons why people are expecting that there's not going to be a recession, should rather really be in a strong positioning because this is a very, very good number to be in at 4.2%. However, this is also a very incredibly lagging indicator. It takes a lot of time for this number to play out. And same goes true for initial claims and continued claims growth. That is as about as lead time of 1 week as we can get, but that is also in a very, very normal rate at about negative 0.8% and 2.5% higher on a year-over-year basis. Now, JOLS to unemployed persons, this is the ratio between job openings and the unemployed persons in the US. It has been coming down. It is relatively weak because we were well over 2.5 times, and now we've come down to closer to 1. And the moment it drops below 1, I think it's going to switch over to more weak. But we've got personal savings 2.9%. Manufacturing PMI is in contraction at 47.2%. We got services PMI and loan growth definitely also relatively weak here. Technically, services PMI a little bit more on the expansion side, but still weakening. So if you keep track of a lot of these indicators, this is all the data points, right? This is literally all data. We're not making stuff up here. If you want to be objective, you can pretty much look at this number and try to figure out, okay, what is going to be the likely scenario in the U.S. economy moving forward in the next 3 to as much as 6 months. And the big wild card now, since we've already got the 50 basis point rate cut, is inflation, right? It's going to be over here. That's why I've put in a red box right next to it, because it's now going to be on high alert whether inflation is going to start accelerating back up if money, once again, is going to be cheaper. It's going to be cheaper to borrow, cheaper to spend, cheaper to invest. And if those are the reasons why the Federal Reserve is doing that rate cut in the first place, because they want to stimulate some spending once again so that businesses can continue to make more money and hire more people and unemployment doesn't go crazy, then in that case, inflation is at risk. Once again, it becomes vulnerable to start accelerating back up. And that's why it's a huge wild card and something that we have witnessed from back in 1970s and 80s when the Federal Reserve decided to cut interest rates. Inflation absolutely went berserk and essentially pushing back higher. U.S. stocks climbed sharply on post-Fed cut cheer. And this is from today, just to give you a little bit of a comparison example of what the headlines are today versus what the headlines were about 17 years ago, if you go back to 2007, pretty much. And this right here, the Fed's big rate cut gamble risks policy error. And this is also reported by MRB Partners Thursday, writing that the Fed's decision to begin its rate cutting cycle with a jumbo cut in September, despite believing that the economy is in good shape, has all the makings of another policy error, as ongoing strong demand may revive inflationary pressures. And the risk is that the Fed will have to backtrack on rate cuts later this year or in 2025, similar to the policy error made in 2021. And they also mentioned something that I wrote down in my yesterday's market update. In the comments, I said that the jumbo cut was highly unusual, and also that the U.S. economy is in a good shape. That's what Jerome Powell said. These were his statements. U.S. economy is in a good shape and the labor market is at a strong place, was also at odds with the decision to deliver a larger cut. And take a look at what my comment was 23 hours ago. I pretty much mentioned the markets also believes that the Fed may have overdone the rate cut and it wasn't necessary to do a 50 basis point jumbo cut this meeting. You don't cut more while also stating that the economy is strong and the labor market is tight and you feel confident, right? So think about it, right? That action is contradicting the statement, right? So the decision to go bigger at 50 basis points contradicts the statement itself. And that's exactly what I mentioned in my yesterday's live stream as well. The Federal Reserve, Jerome Powell, is not going to come out here and tell you, folks, we expect a recession. Folks, we see the economy weakening. We see more unemployment. We see more trouble, more pain in the economy in the future. They're never going to say that. They're never going to say the obvious. So they have to put on a brave face and they have to tell you the economy is strong, right? The labor market's tight. Everything is fine. But yes, we're cutting by 50 basis points, but we're still cutting more than what we usually do, which is 25, or at least to get us started at 25. So the point is that there's a couple wild cards that we have to address, which is what happens with inflation now, right? Is it going to start accelerating back up? And what actually happens with economic growth? Are these indicators going to start weakening? Because look, consumers, they're tapped out. They're literally depleted. Like, ask yourself, ask your friends, family, ask on the ground situation, what's happening with prices as they continue to rise higher and higher? What's happening with savings as they continue to go down and get depleted? What are the consumers relying on? It's really credits, right? Credit cards, delinquencies are also on the rise, but it's really debt that everyone is relying on, right? To basically service this economy moving forward. So a couple wild card really is going to be inflation. What's going to happen with inflation after the bigger rate cut announcement, and a few more that the markets are expecting, and the Federal Reserve's expect to deliver another 2 rate cuts this year. And then really what happens with economic growth, spending, earnings for companies, of course. But we'll keep a track of these data points to really better understand which ones are weakening, which ones are already weak, and which ones are becoming stronger, or which ones are at a more normal rate. Because this is really what's going to dictate how the economy moves forward. I was also looking at a few other indicators which were suggesting on an inflation-adjusted prices, home prices are at their highest level ever on an inflation adjustment basis, and that's what's making housing affordability out of reach for most Americans, which is also one of the biggest signs that buyers are not stepping back in. Like, literally, buyers are not stepping back in to buy homes despite the reduction in mortgage rates that we're seeing in the US. It's come down to 6%, maybe even sub 6% if you come down to those levels. Buyers are still not able to afford home purchases given how high home prices are. So if that continues to move in the wrong direction, if CPI starts to accelerate, I think that's where the risk really is. So while the markets are cheering this bigger rate cut, as they always do, because it's start of a quantitative easing cycle, I really want everyone to be prepared, hedge, and also understand that while in the short term, this may seem like the best decision the Fed's ever made, right? It's the best thing the Federal Reserve did for the markets to push us higher to new all-time highs. We can come out here and talk a lot about our gains and our returns. My portfolio's up $20,000. I'm not complaining about it, but it's my job to be as objective as possible despite where I would profit. Like, my portfolio hit a new all-time high. It literally hit a new all-time high. I'm super blessed and super happy about it. But at the same time, I cannot take that and let me bias with where I see the economy or the markets headed. So I'm giving you straight up, despite what you may believe that, okay, I'm long, doing well, but at the same time, I'm here to give you the facts, literally the data points. So anyway, so market bull Tom Lee hesitant to jump into this post-Fed rally as well. So you got under Tom Lee, one of the most bullish of all analysts out there. This Fed cut cycle is setting the stage for markets to be really strong over the next month or 3 months. However, he added that he's not yet fully confident that stocks will continue their upward trajectory as the U.S. presidential election in November looms. And he said that what the stocks do between now and, let's say, the election day, I think there's still a lot of uncertainty. And that's the reason why I'm a little hesitant for investors to dive in. And again, it's just one of the ways that Tom Lee's telling you that, look, be careful, understand that there's upside risk here. Of course, downside risk as well, because markets have moved up to a price earnings multiple, way beyond 25 now, I feel, based on the expected earnings. So we're trading at a valuation, which is expensive. We're also looking at a lot of individual stocks that may be overbought. Volatility is coming down to its lowest level. I'm going to be sharing the MoneyVest Index in our community. That's going to be more, private to the community members now moving forward. So there's a lot of signs, as well as a lot of economic signs that are suggesting for some weakness that is brewing underneath the economy. Now, this right here is my options portfolio. Again, I shared it with everyone. That's the performance against the S&P 500. Shared a few more lessons. And like I said, the goal is going to be for this to move very, very consistently. Discipline is very important with this approach when you are selling options in the first 4 weeks. So 4 weeks officially ended tomorrow. For this options portfolio, I'm up a little bit over 4%. S&P 500 is up just over 1.5%. So if you want to keep track of what I'm doing with my options portfolio every single week, what I'm selling, what I'm buying, what trades I'm taking, link's going to be down below. We'd love to have you on board. If you have any questions whatsoever, please do let me know. So coming back over to the market, a lot of the gains were from technology, as we already know. It was a very, very big risk-on trade as Magnificent Seven collectively rallied almost $500 billion, up over 3%. The top 10 were also up almost 3%, going up to over $500 billion. Some of the big losers on the day, we had Walmart, Visa, Procter & Gamble, Coca-Cola, Nexera Energy. So you can kind of really drill down to some of the indicators such as utilities down over 6 billion or about 0.5%. So utilities were selling off. If you come over to, let's say, banks over here, so banking was up almost 40 billion or up 2.5%. So that's where liquidity also went to. But if you come over to staples, right? So let's come over to, let's see, consumer products. If you come over here, so down over 4.27 billion or about 0.5%. And then let's see, what other indicators can we look at? So energy, for example, was pushing higher on the back of higher oil prices. And we got also materials, I think, was also one of the sectors which has done really well, which in my opinion, it's possible that it starts to roll over. Tobacco, down about 2.5 billion. So again, these are considered to be recession-proof stocks here, which were obviously selling off here on the day. And most of that liquidity basically only went to just a select few companies, such as your Magnificent Seven, your technology stocks, right? So it was a very, very risk-on trade, with NVIDIA pushing up almost 4%, QQQs, so NASDAQ pushing up 2.5%, S&P 500 up 1.7%, and Tesla having a fantastic day, 7% higher, $244. Now, Tesla, it actually does benefit in a lower interest rate environment, but at the same time, you have to keep close eyes on where the demand is and how strong the consumer really is. Because if consumer affordability continues to go down because of the savings rate and of course the reliance on debt because of higher prices, then even at lower interest rates, it's not going to benefit the consumer all that much. So that's why I think it's really important to keep track of a lot of these indicators that we are looking at, and I'll constantly update you guys with where we are. Now, coming over to volatility, getting crushed down over 10.3%, so a little bit over 16 right now. Next target is going to be closer to 15. That's the level to keep in mind for the VIX. And if you come over to crude oil prices, we're seeing a little bit of that bounce back higher, back up to over $71 per barrel, up almost 3% right now. So we're starting to see that momentum back up for crude oil. And now coming over to individual stocks, starting with S&P 500, Tesla with a huge breakout, which we'll discuss here in just a minute. And of course, S&P 500 also with a massive, massive breakout above the 5,700 level. And this right here was the consolidation for S&P for a long time. We'll go ahead and turn this level back into a support, but I will most certainly be hedging. I will be selling covered calls. I will be selling puts on the way down. I will be raising more cash. I will be careful. I will certainly be very, very careful in this market environment if things were to take a turn similar to what we have witnessed. I'm not saying it's going to be something similar to 07. History doesn't repeat itself, but it does rhyme. So if it's even something remotely close to what we have witnessed before, if there's economic contraction, recession happens, all bets are going to be off. You better believe it. Investors are going to be flocking away from risk over to safety. It's going to be a very defensive, essentially defensive environment in the market. And that's where TLT and TMF tend to rally a lot more, because those are bond ETFs, utilities and staples, again, some sectors that could benefit from that rotation. So it's just a wait and watch approach right now. While we can participate in this rally, great. But at the same time, I think we have to be aware of some of the risks that are still present within the economy and the markets as well. So support level is going to stay put at 56.68 down to as low as 56.40. So those are levels to keep in mind for S&P. Hitting a new all-time high, so there's not really much for us to go over. And QQQs also, I think within 3% of their all-time highs. All-time high sits at well over $500. We'll go ahead and turn this level back into a support for QQQs here. And resistance at 487 for the NASDAQ as well. So that's going to be that resistance. Support level is going to stay put at 475, 476 for QQQs. Coming over to Apple, incredible day, right? So 3.7% higher, pushing up very nicely. Resistance is going to be all the way up to $236 for Apple moving forward. Support level is going to stay put here inside this green rectangle moving forward. Talking a little bit about Amazon. And Amazon here also, very nice consistent move up, 1.8% higher. Support level is going to stay put right about there at around $189, close to $190. And the next target or resistance is going to be pretty much the all-time high at $200, $201 for Amazon. So that's going to be that level to keep in mind. Tesla with a huge breakout. Very, very nice candle coming in. Lots of supply getting gobbled up. I am going to be looking at selling some calls here very soon, most likely in the 270 range. We'll be looking at selling calls upwards of 350s or 375. A little bit like 30 to 45 days out. So that's going to be that next trade on Tesla. And we'll go ahead and turn this level back into a support after a very, very nice rally for Tesla. So that's going to be that next target at 267 to as much as 270 for Tesla moving forward. NVIDIA, on the other hand, a very nice move, but still not able to close above 118. quite interesting. So I placed the trade for next week on Nvidia. I also closed out my puts for 93% profit. We'll be placing in new trades tomorrow on CSPs, just waiting for a nice little red day for Nvidia so I can sell some puts again. And this right here is going to stay put at that resistance of 118, support level down to $96, $97 for Nvidia moving forward. Talking about advanced micro devices and AMD here also pushing up over 5.7%, so very, very nice move to the upside. Resistance is going to stay put at 162 for AMD. Support level is going to stay put down to 142, all the way down to $122 for advanced micro devices. And then also coming over to PayPal. PayPal had a fantastic day, pushing up a little bit over 6% here, $77. Nothing's stopping PayPal now, the highest level since April of 2023, and a huge breakout above this level as well. Next target is going to be $88 for PayPal. We'll go ahead and turn this level back into a support now. I never thought we'd be turning a lot of these levels into support that have been previous resistance levels, so that's great to see. Visa with an underperformance, that was pretty known to us considering how overbought this was. RSI MACD starting to roll over a little bit, the price itself dropping a little bit over 1%. So again, support level is going to stay put down here at 282. Pretty much got validated. It's actually perfectly validating here. 282.87 was the low for the day. We had it marked out at 282.88, so we're off by 1 penny here. So just wild how that level got validated perfectly. Meta with a new all-time high. So perfect breakout here above this area of resistance at 540. Still kind of trading inside this area of supply. And we'll see what happens here, but we can go ahead and turn this level off, and this is going to be that support level to watch for Meta moving forward. So that right there is going to be now an area of support for this company to watch. 540 is going to be that support now. Talking about Netflix, and Netflix here, very, very briefly hitting a all-time high of 715, and again, support level is going to stay put right about here, close to around $700, all the way down to 661 for Netflix moving forward. So it's the highest level that we've hit since November 2021, so a new all-time high for Netflix, and support level is going to stay put down at 662 for Netflix as well. Coming over to Google, nice little rejection as we discussed, so green day but a red candle getting rejected right about there. Support level is going to stay put down at 150s for Google here, so this perfectly played out as expected. We had a significant sell-off, bear flag, breakdown, validation of that support, pushing right back up, getting rejected at that resistance, and then rolling back right back down here. So support levels in the 150s for Google as well. Microsoft, on the other hand, again, green day but red candle, definitely does suggest there was selling pressure intraday, and support level is going to stay put down to $432 for Microsoft, and resistance all the way up to 467 for the company, right? So that's pretty much near the all-time high for Microsoft moving forward. Enphase rolling right back down, so down almost 2%. Again, we've discussed this as a resistance, so you can see that we don't make up these things, right? We talk about them, where those area of resistance, support level, where that area of demand and supply is, and most often you'll notice stocks do tend to follow that timeline really well. Of course, some stocks will break out. Tesla, PayPal broke out very nicely. Visa and Enphase got rejected at those resistances, and so did Google. And a lot of individual stocks also getting validated at very good support levels and then pushing right back up. So this is overall Enphase, just consolidating sideways. And then finally coming over to Costco, which on the day was also very flat, just up about 1%, but a red candle. And this right here is going to be that near-term support to watch for Costco, all the way down to $872 per share. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below, and what is your expectation of the economy moving forward with your understanding of where we are in the economy here, because there's a lot of signals that are weak or relatively weak out of all the ones that we're looking at. So we're looking at 13 indicators right now, with only a few that are now strong or in the normal zone. So let me know in the comment section down below. As always, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.